presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for March the 7th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for joining me today. Let's take a look at the markets. I'll talk a little bit about the Fed, what's going on with them. We heard Jerome Powell testify in the Humphrey Hawkins semi-annual testimony today. What did he say and how did that impact the market? We'll take a look at the market, the economy, technical analysis, and the next few days. They are going to be critical in determining if we get a deeper correction, we head to lower lows, or we find some balance here and we start moving higher. The Fed the Fed fund rate and inflation start to converge. They're starting to coming together. But we are seeing the Fed target rate of the Fed continuing to move. Today, Jerome Powell said that he might have to raise rates higher, faster, and stay higher for longer. So with all of that said, what they're saying is with the data coming out right now the Fed has tried to slow down the economy. It is not slowing. They've tried to slow down employment. It is not slowing. They're trying to slow down inflation, which has slowed, but it is not slowing at the pace they want. So far, what all the Fed has done with all the interest rate increases, nothing has happened. The consumer continues to spend, and as long as that's 2/3 of the U.S. economy, as long as the consumer is spending, the economy continues to move forward. Sooner or later, the consumer is going to hit a brick wall, but what point is that? Will the Fed go too far in raising interest rates? We're seeing some slowdowns in sectors of the economy. The housing market has slowed dramatically. Car sales have fallen off dramatically because payments have gone up on both quite a bit as interest rates have gone up, and affordability is becoming more and more of a problem. But people are still spending, but experiences, they're going out, going on vacations, traveling, going to restaurants, because they're saying, look, we had pent-up money, we're spending, and we have a job. As long as I have a job, people are spending and saying, I'll put it on the credit card and I can pay it off as I work. That is, I've said that for the last year and a half. If you tune into a daily edition of Market Wrap, I've talked about that quite a bit. Employment is the key. It's when employment starts to go up, that's when people get scared and say, I better not spend this because I might not have a job next week or next month. As long as people have jobs, and there's plentiful of jobs out there. So we're going to get some data on that. Implied rates are that the Fed was going to, this was the post-jobs report, the CPI and retail sales and the PCE. Now everybody's expecting that the rates will top out somewhere around 5.44. Today, the market expectation is that rates could go as high as 5.6%. That's what they're looking at. And right now we're at about 4 3/4. So we could get another 25 to 50 basis points. The chances of a 0.5% increase in interest rates has gone up to about 70% as of today after Powell's testimony in front of Congress. I think, again, that's the market where we were at the beginning of February, where everybody said Fed will be cutting interest rates by the end of this year. Everything will be wonderful. And now we've come full circle. So forget about Fed cutting rates. Now they're saying the Fed is going to continue to raise rates and raise it at a faster pace. I think the market is overreacting, but that'll depend on the unemployment data that we get on Friday, and then the CPI, the Consumer Price Index inflation data that we get on Tuesday. If both of them come out stronger than expected, we could get a 0.5% interest rate increase. I still think the market is overreacting, but it's data dependent. Depends on how strong the data is on Friday. Looking at the market, again, estimated earnings continue to move lower, the estimates are. But if we're not having a recession, the problem is the economy is not slowing. It's doing too well. That's the problem. Unemployment is staying way too low. That's the problem. So why is everybody discounting earnings? Everybody's saying earnings are either the economy's got to slow, so companies can't sell as much, and that brings earnings down. But if the economy is doing well, then earnings might surprise to the upside. That is what we're looking at right now. PMI boosts in February. Again, we had the PMI, and I have the chairman of the services, ISM services and non-services, chairman of both of those committees on the broadcast. So you can tune in on the daily edition of Market Wrap and get that. Employment is going up. We're starting to, the PMI came in on February, again, better than expected. Growth projections through 2024, again, the GDP numbers are being revised upwards right now. Don't forget to tune into daily edition of Market Wrap. You can go to Market Wrap with Mo Ansari and the Apple Store and download the app. It is free. Looking at the technicals, the S&P, we closed today at 39.86, and as long as we stay above 39.40, and this low is 39.28 right here at the end of last month, as long as we stay there, we're okay. If we break 39.40, then we have a little bit of support right here, which is 3,900. And then if we break, the major support is right here, which is 3,800. So market has got a decision to make, and I think it'll depend on the employment data on Friday and on Tuesday on the inflation numbers. Looking again at the weekly charts, each one of these vertical lines is 1 day of trading. 4,200 is the major resistance. I've talked about that for months since we hit that 4,200, even at the beginning of last month. Now support is at the 50-day moving average, which is 39.91. We closed at 39.87 today for the S&P, and then 39.72, which is a 20-week moving average. We'll see how this works out. Looking at the Nasdaq, still looking better. 11.4 is critical support, and 11.3. 11.4 is the 200-day moving average. As long as we hold that, we closed 11.530 today. So we will see how this works out again. Over the next couple of days, I think the market will bide its time, wait for the employment data to come out on Friday. The weekly technicals still positive. As long as we stay above 11.2, we're okay. And we are at 11.530 today. The dot plot, these dots turn negative at 10,500. Gold, as I mentioned earlier, gold had a terrible day today. But interest rates go up, gold goes down, but we have to hold about 1780. If we break the 200-day moving average on gold, the S&P, and the Nasdaq, I think that would set up the market for a deeper correction. I still am hoping that the market is going to hold those support levels. If not, then you have to get a little bit more defensive on your portfolios. I'm still looking at these declines as buying opportunities. I have a webinar coming up next week on the 14th. You can go to compak.com and sign up. You can go there and sign up at compak.com. And Scottsdale, I will be there on the 4th of next month, so you can make a reservation simply by going to compak.com. But look, a week ahead, I think the CPI number is going to be critical, and that's going to be the driver of the market. Those are my views. Those are my thoughts as of March 7th. Don't forget to tune in again and subscribe to this channel so you can get, whenever I put a new update out, you will be notified. Have a wonderful week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.